Alright, so let's talk about something that I see tripping up so many people when it comes to their money. We all have that fear, right? The fear of waking up one day and seeing your hard-earned cash just gone, especially when you hear horror stories about the stock market. But here's the kicker. The thing that most people don't even see coming, the real monster under the bed, isn't that roller coaster market volatility. No, it's something far quieter, far more dangerous over the long haul. It's the slow, steady loss of your money's actual buying power. This silent enemy, this financial ninja, has a name. It's called inflation risk. It doesn't make loud noises, it doesn't crash markets overnight. Instead, it's like a tiny leak in your financial boat, slowly but surely sinking your purchasing power year after year after year. Most people are so focused on not the dollars they have, they forget to make sure those dollars can still what they need. So in this video, I want to break this down for you. Let's get into it. Alright, so let's kick things off with something we all know: bank accounts. We all have them and we all rely on them for various financial needs, from saving money to paying bills. But have you ever stopped to think about what it really means for your money to be safe in a bank? When people talk about their money being safe in a bank, what are they actually picturing in their heads? Is it a vault with thick steel doors, or maybe a digital fortress that hackers can't penetrate? Usually it's a few core ideas. They imagine their money is secure, untouchable by anyone but themselves, and always available when they need it. First, they're thinking that the number they see on their bank statement isn't going to suddenly plummet overnight like a stock might. They expect that their balance will remain stable without any sudden unexpected drops. There's no heart-stopping drop, no red arrows pointing down. Unlike the stock market, where values can fluctuate wildly, a bank account offers a sense of predictability. That stability feels good, right? It feels predictable. You can plan your finances without worrying about sudden losses. And they're not wrong about that part. Banks are designed to offer this kind of stability, which is why so many people trust them with their hard-earned money. Your principal, the actual amount of money you deposit, isn't supposed to go down. This is a fundamental promise that banks make to their customers. If you put in $1,000, you expect to see $1,000 there, plus maybe a tiny bit of interest. This interest might not be much, but it's a small reward for keeping your money in the bank. This sense of stability is a huge draw for a lot of folks who are, understandably, risk-averse. They prefer the certainty of knowing their money is safe over the potential for higher, but riskier, returns. Then there's the big one, FDIC insurance. This is a key feature that adds an extra layer of security to your deposits. You see that little sticker at the bank, or that mention on their website, member FDIC. It's a small detail, but it carries a lot of weight. That means your deposits are insured by the federal government, typically up to $250,000 per depositor per insured bank, for each account ownership category. This insurance is a safety net that protects your money in case the bank fails. This is a massive safety net. It provides peace of mind, knowing that even in the worst-case scenario, your money is protected. It means if the bank somehow goes belly up, your money, up to that limit, is protected. This assurance is one of the main reasons people continue to trust banks with their savings, despite the low interest rates. Alright, so we've established that safe in a bank account doesn't mean your money's purchasing power is secure. But why is that the case? Why do we often feel that our money is safe just sitting in a bank account? Let's dive deeper into this topic to understand the underlying reasons. Now let's go a little bit deeper. The concept of safety in banking is multifaceted. It's not just about the physical security of your money, but also about the perceived stability and predictability of returns. Why are these types of accounts, your standard bank checking and savings accounts, and even things like certificates of deposit or CDs, so universally labeled as safe in the first place? The answer lies in a combination of historical trust, regulatory frameworks, and the nature of these financial products. What are the mechanics behind that label? Banks have built a reputation over centuries as institutions where your money is not only stored securely, but also managed prudently. This reputation is bolstered by stringent regulations and oversight by government bodies. Well, as we touched on, a primary reason is that they typically guarantee your principal. This means that the amount you deposit is protected, and you can expect to withdraw the same amount, barring any fees or penalties. You put in $5,000, you expect to be able to take out $5,000, plus any accrued interest, however small. This assurance is a significant factor in why people trust banks with their money. There's no risk of that initial sum disappearing due to market fluctuations. Unlike investments in stocks or mutual funds where the value can vary widely, the principal in your bank account remains stable. This is fundamentally different from stocks, where the value can go up or down, sometimes dramatically. The stock market is influenced by a myriad of factors, from company performance to global economic conditions, making it inherently volatile. That guarantee of principal is a cornerstone of their perceived safety. It provides a sense of security that is hard to find in other investment vehicles. Secondly, these accounts offer fixed, or at least highly predictable, returns. When you deposit money in a savings account, you're often given an interest rate that is either fixed or changes very slowly over time. When you open a savings account, it comes with an advertised interest rate. This rate is usually modest but stable, providing a predictable return on your deposit. It might be variable, meaning it can change over time, but it's usually pretty stable and you know what it is. This predictability is one of the key reasons people prefer savings accounts for their short-term financial goals. With a CD, you lock in a specific interest rate for a specific period, say 1.5% for 1 year. This predictability is comforting. You know exactly what you're going to get, and this can be particularly appealing in uncertain economic times. You know exactly what you're going to get, unlike the uncertain returns of the stock market. This certainty allows for better financial planning and peace of mind. And then, as we mentioned, there's the government insurance factor. In the United States, for example, the Federal Deposit Insurance Corporation, FDIC, insures deposits up to a certain limit, adding an extra layer of security. This insurance means that even if the bank fails, your money is protected. Alright, we've talked about bank accounts. Now, let's move up the perceived safety ladder a bit and talk about something you often hear described as the safest investments in the world: U.S. government securities. This includes things like Treasury bills, T-bills, Treasury notes, T-notes, and Treasury bonds, T-bonds. Why do these get such a gold-plated reputation for safety? There's one overwhelmingly powerful reason, and it's pretty straightforward when you break it down. The U.S. government has the unique legal authority to do two very important things to ensure it can meet its financial obligations. First, it has the power to tax its citizens and corporations. Second, through the Federal Reserve, it has the ability to, essentially, print money or create currency. Think about that for a second. The entity you are lending money to when you buy a Treasury security has the ultimate power to raise funds through taxation across the entire U.S. economy. If it needs more money to pay its debts, it can, in theory, increase taxes to generate that revenue. That's a pretty significant tool that most other borrowers, like companies or individuals, simply don't have. So what's the biggest takeaway from all of this? What is the one lesson that you should carry with you as you navigate the complex world of finance and investments? It's that the real risk, the one that truly matters for your long-term financial health, isn't just about those scary short-term drops in the stock market. While these drops can be unsettling and even frightening, they are often temporary and can be managed with a well-thought-out strategy. The real, fundamental risk is what happens to the value of your money over time. This is a risk that creeps up on you slowly, almost imperceptibly, but its impact can be devastating if not properly managed. The erosion of your money's purchasing power due to inflation is a silent thief that can significantly diminish your financial security. Market volatility, those ups and downs, that's often just short-term discomfort. It's like turbulence on an airplane. It can be unsettling, but it doesn't necessarily mean the plane is going to crash. But inflation risk, the steady erosion of your purchasing power, that's a long-term danger that can silently sabotage your financial future. Over time, even a modest rate of inflation can significantly reduce the value of your savings and investments. People are so often terrified of losing money in the market, and that's understandable, but they completely forget that they are almost guaranteed to lose real value when their money isn't growing enough to outpace rising prices. This is a risk that is often overlooked, but is just as important, if not more so, than market volatility. To protect your financial future, you need to be proactive and strategic in your approach. So, how do you actually avoid this fundamental investment risk, this inflation trap? First, diversify. Diversification is a key strategy in managing risk. By spreading your investments across different asset classes, you can reduce the impact of any one investment performing poorly. Don't put all your eggs in one basket. This old adage holds true in the world of investing. A well-diversified portfolio can help you weather the storms of market volatility and protect against the erosion of purchasing power. Mix those safe instruments we talked about, like some cash for emergencies and maybe some bonds, with growth assets like stocks or real estate. This balanced approach can provide both stability and growth potential. This helps balance protection with the potential for real growth. A diversified portfolio can help you achieve your financial goals while managing risk. Second, consider using inflation-protected securities like TIPS, those Treasury inflation-protected securities. These are government-backed securities that are designed to protect your investments from inflation. These are specifically designed to adjust your principal with inflation, helping to preserve your real value. By including TIPS in your portfolio, you can add an extra layer of protection against the eroding effects of inflation. Third, invest for the long term. Long-term investing allows you to take advantage of the power of compounding and the general upward trend of the market over time. Historically, investing in a diversified portfolio of equities over the long haul has been one of the most effective ways to beat inflation and grow wealth. The stock market has shown a tendency to recover from downturns and continue its upward trajectory over the long term. Patience is often a much better risk manager than panic. Staying the course and not making impulsive decisions based on short-term market movements can lead to better long-term outcomes. And critically, understand the difference between safe and secure. Safe investments might protect your principal, but they may not offer enough growth to outpace inflation. Secure investments, on the other hand, aim to provide both protection and growth, helping you maintain and increase your purchasing power over time.